Hi, this is Vijay Bhambwani and I welcome you for my sixth video edition of the Market Weekly Outlook, and that too in video format. I hope you enjoyed the previous five editions of our weekly market wrap, and you've benchmarked our levels that we've provided for the markets and the triggers along with the methodology of what we look at in the market and how the pull and push between various asset classes, various markets have an impact on other asset classes. So here goes, and in this fifth edition, I'm going to talk about what really happened in the market in terms of the superlative edge of the seat excitement as both the indices roared higher. Admittedly, I was a little circumspect in my previous weekly edition. I thought there would be a slight skew. I used the word slight skew in my last week's video towards the downside. But the market overcame all that, proved me wrong, and went higher. It's a tad, the Nifty is a tad below its all-time high, as you will see in the charts up ahead. So will the previous week's exciting performance basically result in a similar kind of a rally in the coming week? We're going to take this step by step. Now, basically what we'll begin with is the market roundup. As you can see on your screen, the Nifty gained 5.34% while the Bank Nifty gained 12.12%. So it was the banking stocks which were in the limelight, and because of no small measure triggered by the 10-year benchmark yields which fell from 5.87% last week to 5.58% in the week gone by, which means the bond prices went up, mark-to-market profits for the bank's bond portfolio. Also do remember, as you're seeing on your screen, the USD INR, basically the dollar index, the dollar index fell on a week-on-week basis, and I have been advocating that a weak dollar is actually bullish for emerging markets and countries like India, because we are an import-dependent nation, we have debts in USD, and a weak dollar makes imported inflation lower. Anything that we import becomes cheaper, and therefore it helps our markets. So do note that there is an inverse correlation between the Dixie and our markets here, and a falling dollar actually helped us last week, which is something that I indicated. The above average volatility was due to the US elections and the kind of close call that you had for a while between Donald Trump and his challenger Joe Biden basically created an edge of the seat excitement. Typically on Thursday especially, where we saw the markets actually go from negative to positive, the drop of a hat and the turn of a dime. The statistical beta on both the indices has shot through the roof, and what you're seeing on your screen is the statistical beta of both the Nifty and the Bank Nifty. This basically tells you that these are markets that you should not trifle with. You should not treat them lightly, nor should you get any more reckless than you should be, because a slight move here and there against the market, a slight carelessness, and you're going to be out of money and lose a great deal of your trading capital. The volatility is simply way too high as of now. So I continue to advocate what I advocate on my social media pages every evening, Monday to Friday, in those 3 statistical updates that I put up, that you must continue to trade on very light exposure. Now, after the statistical beta that you saw in the previous slide, I now draw your attention to the market-wide MWPL, which has basically risen in the last 1 week by 21.58% on a base effect basis. This basically tells you that after expiry, traders have ramped up their positions fairly rapidly, with a great degree of even more expectations of profits from the markets, and that tells you that volatility is likely to stay high. Now we come to the open interest, which you see on your screen. It shows a steep rally in the Nifty, which means that the traders are expecting a broader based rally in the markets in the coming week as compared to the open interest in the bank Nifty, which is relatively speaking a narrower index because it has only 10 stocks compared to 50 stocks of the Nifty 50. So the bank Nifty remaining open interest remaining flat tells you that the action is actually likely to be on the Nifty 50. Volumes on the indices have generally fallen, as you are seeing on your screen, on a week-on-week basis because higher levels have seen thinner participation because caution amongst the retail traders segment is fairly high. The roundup done, we now go to the fountainhead of the money markets, which is the bond market. The 10-year benchmark bond yield, which I told you fell from 5.87 to 5.85%, and we saw that the banks continued to exhibit a sign of flight to safety. And the RBI also announced a proactive policy of continued LTRO, which means buying back bonds. And basically, markets are expecting the government to continue with this sustained LTRO process to basically cut down its own borrowing costs, so that interest charges are likely to remain subdued, which means senior citizens and those investors who depend heavily on fixed income investments for a substantial portion of their income are likely to remain on the ropes. Now we come to the Dixie, or the US dollar index, which is a basket against a basket of global currencies as a benchmark. Now, I have been talking in my previous videos as to how, unlike other US elections, this time around, the US administration has failed to pull the US dollar index, or the Dixie as it is popularly known, substantially higher. And that's something that emerging markets have basically taken a cue from and risen for. Now, this currency benchmark has fallen from 94.038 in the week prior to the last to 92.229 in the last week, which ended on Friday, which is a fall of 1.92% on a week-on-week basis. Now, believe me, that's very steep for a currency. The index, as you can see on your screen, has fallen on 4 out of 5 sessions, and the falling red candles have been more prominent and fairly large compared to the green or the rising bullish candles in the immediate past. And the US presidential election had a lot to do with this fall. The index, the dollar index falling is good for the emerging markets, including India. And my theory of an inverse correlation between the Dixie and the emerging markets, including India, has been validated. This hypothesis has been proved right by the market action. Last week, I advocated a range between 95.40 to 92.90, which 92.70, which was violated on the downside because the falls were so prominent. Now, in the coming week, I expect an estimated, I emphasize on the word estimated here, an estimated range between 93.65 on the upside and 90.80 on the downside. The US dollar index done, I now proceed and take you through the bank Nifty. Now, this was really the star performer of the markets last week. And it rose on all 5 trading sessions and closed above the previous swing high of 31st August 2020, as you can see on the chart on your screen. The index wound up gaining 12.12% on a week-on-week basis and outperformed the Nifty 50 by a huge margin. In the week prior to the last, the Bank Nifty was number 5 on the most volatile list on the NSE, but it has climbed to number 2 in the most volatile list in the week gone by, which means the statistical beta, or the measure of price volatility, has risen sharply, and it has flown off the handle, and the index denoted in red versus the Nifty shown in the blue in this graph will tell you what I'm talking about. Now, this kind of a rise in volatility is not something that you should take very lightly. The price chart on your screen shows a breakout above the bullish channel and is now at its highest. The price is highest after 9th of March 2020. Wow. So you're basically at 8-month highs. And the Bank Nifty has also broken out above a minor resistance lines shown as dotted blue lines in the week gone by. And in the last week's video, I basically advocated expected range between 25,400 and 22,400, which was overcome on the upside. Obviously, the rallies were far sharper, and the range expanded last week. The coming week might see an estimated range. Here I again repeat and emphasize on the word might and estimated range, between 28,500 on the upside and 25,150 on the downside. I repeat my advice of trading light on the markets, and do remember that these ranges might just even be exceeded because of the sheer emotionally charged nature in the price and undertone in the markets. And since the beta is extremely high, you basically will gauge it from the numbers that I'm walking you through now. The beta rose 23% on a base effect basis on Friday's session alone, and 212%, which means the beta actually doubled in the last 5 trading sessions, which is the last 1 calendar week on a net base effect basis. My friends who use statistical data models to make their own trading decision support systems and automated support resistance and pivot levels will need to keep this in mind about the significant elevation to the extent of 200+% rise in statistical beta, and plan their trades on the Bank Nifty accordingly. Now I take you through the Nifty 50, the most liquid and the most low impact cost instrument available in the futures space out there on the NSE. Like the Bank Nifty before it, the Nifty 50 also rallied on all 5 trading sessions of the week, but it wound up gaining 5.34% as against 12.12% by the Bank Nifty. So it underperformed on a week-on-week relative basis. The rally took the Nifty past the large red candle which it had made on 15th of October 2020, and it had become a near-term resistance, which I had advocated in my video last week as well. This was the first noteworthy point out of the 3 points that I mentioned in my last week's video, and we'll basically update ourselves as to what really happened to all these 3 points. So the first point was the high made on 15th of October. That's been overcome, and the Nifty has closed comfortably above it. The second was the megafoam formation, which means diverging trend lines, the red and the blue trend lines, which are basically moving away from each other, which basically tells you that the range was likely to expand, which means volatility was likely to go up. Now, this megaphone formation has been overcome because the price has now closed above the rising trend line. And the third one was the negative divergence between the price and the RSI, which means the price was rising, but the RSI, as you can see on your screen, was falling. Now here again, I've drawn a falling trend line on the RSI and marked it with 3 arrows. You can see that the RSI is now very excitingly perched just below the falling trend line. Should you see one or two trading sessions where the Nifty rises, the RSI itself will signal a breakout on the upside, which means that the Nifty might just receive another bullish trigger, of course subject to follow-up buying coming in from the bulls and a race towards the new high, which is marked on your screen as being marginally above the current levels. Now, any further up move will basically be accompanied by extremely high beta, because you're approaching the all-time high of 12,430, which you're seeing on your graphic. And as markets go towards testing a previous resistance, volatility and the tug of war between the bulls and bears invariably escalates. Now, last week I advocated an expected range between 12,075 on the upside and 11,200 on the downside, which was obviously overcome, just like the Bank Nifty's targets were overcome. And the coming weeks expected possible range, I emphasize on the word possible and expected, range between 12,725 on the upside and 11,800 on the downside. Now, in the week before last, Nifty was number 11 on the most volatile counters list, whereas it has risen to number 8. Now, that's the Nifty moving up the volatility list, which means that the statistical beta is rising. You must cut down on your exposure levels or risk losing money in sudden adverse price moves. How much has the statistical beta actually risen? It rose 34% on a base effect basis on Friday's session alone, and 78% on in the last one calendar week, which is 5 trading sessions. I think it's time for you to exercise abundant caution and cut down on your trading exposure. With the Nifty done and dusted, I now bring you to the final portion of this weekly newsletter. A list of 5 stocks which are high beta, high impetus, which means you can trade them in either direction, depending, of course, on which way the computer trading terminal screen is telling you. High beta, high impetus stocks to be traded on low exposure with expectation of higher price move, versus low beta, low impetus stocks which need to be traded in higher exposure but in anticipation of smaller price moves. So where high beta, high impetus counters are concerned, the first one to come to my mind is an index, the Bank Nifty. Here again, like I said, it's going to be volatile, so trade on low exposure but expect bigger price moves. Amongst individual stocks, high beta, high impetus stocks to be traded. Remember, you will trade in the direction of the trading terminal. I'm not giving you the direction. Let the markets tell you where. The first one in high betas, high impetus, therefore low exposure, is SRF. The second one, Siemens. Number 3, National Aluminium on Alco. Number 4, Voltas. Number 5, Cipla. On the other hand, low beta, low impetus stocks which you will trade with high exposure but with smaller price moves expected is led by Biocon at number 1, number 2, Hero MotoCorp, number 3, Manappuram, number 4, Bajaj Auto, and number 5, NTPC. Now this brings me to the end of this week's weekly market outlook. Coming up on your screen are my contact coordinates and my social media coordinates. I would love it if you connect with me and get conversations going with me, and also check out what I update on my social media pages at the end of the trading session, late evening every day, based on my statistical models. I look forward to connecting with you, and do spread the word with your family and friends by referring my video if you agree with what you see. I hope you have a very, very profitable week ahead and wish you a very happy festive season in advance. I'll see you again in my next week's video. Bye-bye for now. Thank you for watching.